Good day, inderesTV viewers. Sampo published its fourth quarter results. Today I'm interviewing Sampo Group CFO Knut Arne Alsaker. Congratulations for another great quarter and full year results. How would you sum up the development of Sampo last quarter?
Well, thank you. I think the key word for our results and business from 2024 was growth. We have in our result a lot of proof point of the organic growth momentum we have in our business. The top line for the group as a whole grew by 12%, coming from many different areas. It's coming from personal insurance and property insurance in our large private business area. It's coming, not least in the last quarter, from Denmark and the business coming out of Topdanmarkin, which of course also was an important part of last year in terms of our acquisition of Top and completing our transformation to a pure play non-life insurance company. So growth also out of Denmark. It's coming from the UK, where we grew the number of policies, the customer base that we have by a full 400,000 new policies during 2024. So growth is excellent. And of course, this growth is also achieved at very attractive margins, where we met our combined ratio target by a margin, and we really have a growth in the insurance service result, which is important for us, of a full 13% during 2024.
If we think about the Nordic market, can you estimate, are you taking market share or is the revenue growth driven by hiking prices, price inflation?
But pricing and increasing the premium base because of claims inflation is important, still is important, will always be important. And claims inflation, by the way, is stable in the Nordics at around 4%. And ticking downwards, but stable in the last quarter. In the UK, and the level there is high single digits, which we have talked about, and that claims inflation need to be met, which of course leads to premium growth. But we are also taking a market share and new customers. I already mentioned the UK, 400,000 customers is quite a lot of new business. And in the growth area and the focus areas that we have in the Nordics, particular personal insurance, property, the SME segment, we are taking market shares. But of course, market shares in the non-life insurance industry isn't changing dramatically from quarter to quarter, but it is new business and customers coming in.
A few follow-up questions. How do you many are expecting that Nordic economies, I mean especially Sweden and Finland, which has seen more lackluster growth in the recent years, when the growth will pick up, does that change the dynamic in the property and casualty sector?
I mean, economic growth is of course always good, also for our industry. We haven't in our outlook, which we presented today, based our outlook expecting a significant pickup in economic activity. But one of the areas which have been a headwind for us in terms of growth over the last 2 years is car sales. And I believe one of the reasons, maybe the main reason for that is, of course, the economic situations for consumers and buyers of cars. So if that is improving, we could also see a pickup in terms of that part of our business and top line development. But if we see sort of the economic activity in our core Nordic and UK markets improving, that's just of course positive for us.
How has Topdanmarkin integration gone? Have you had any negative surprises there, perhaps?
You can't say so, really. To the contrary, the integration is going very well, maybe even better than I had expected. We have appointed sort of leadership teams across the different business areas, who now are sort of responsible for running the businesses on a daily basis, running the integration, and started to realize the synergies that we have talked about before. So in terms of our confidence on harvesting the benefit of this transaction, if anything, it has increased. And we will, of course, start to update you and the market on the financial progress of those synergies realization now in Q1. I think just the fact that we have a really good momentum in our Danish business going out of 24 is an indication that there's no hiccups in terms of that part of our business coming from the integration.
Good to hear. If we jump to Hastings, even though the claims inflation has been high in the UK, I think there's some pressure in the market prices, if I remember correctly from the report. So how do you see, is there any pressure to margins going forward?
I think margins as such, with one specific number, isn't the most important part of our UK business. Not for the group as a whole either. It is the growth in underwriting profit, and we grew underwriting profit in the UK by close to 50% during 2024. Now, prices have ticked down in the UK, which I think is quite rational. We've had a market where we, and probably also competitors, have experienced a significant reduction in claims frequencies, which of course mean that the increase in profitability is high. And to spend some of that surplus profit, if you like, in terms of being competitive on market pricing, not least coming out of significant price increases during 23, is quite rational. Then there's been some technical changes in terms of discount rates, and it was a good reinsurance renewal. So there's been profit points in the UK, which the market as a whole have used to be competitive on an individual basis. And that's rational. Then, of course, this means that our opportunity to be as aggressive on the growth side as we were in the beginning of the year, it is different. So the growth in our motor book in the fourth quarter in the UK was lower, but it still is not a market with irrational pricing. We have, however, other products where we have in areas where we have grown, bike and van, property, so household insurance, as well as a specific motor product linked to telematics, where we find very much good growth opportunities as we speak.
I think you're not doing any more acquisitions in the Nordic markets because it's already quite consolidated. So, of course, investors are thinking when we see next M&A move in the UK market, how do you view the M&A situation or bolt-on acquisitions in the UK right now? After the last few years with Hastings has been quite good experience after all.
Last 2 years have been a good experience. And for us to have growth ambitions in the UK, we absolutely have. But as for the Nordics, the organic growth momentum that we currently see is great. To risk that momentum by engaging in a large acquisition is not a priority for us. There has been some consolidation, or is some consolidation happening in the UK market, not involving us, which I think will be good for us in terms of the discipline in the market going forward. Then we are always looking at bolt-on opportunities, But again, we are very happy with the organic growth momentum that we have. And M&A is not really our focus area in terms of capital deployment for this strategic period. It is on capital return, which of course also is a part of what we announced today with the regular dividend and the indication of this share buyback later in the year.
Exactly. You gave, I think, perhaps for the first time, quite narrow guidance range for the revenue and underwriting profits. What gives you the confidence to give so narrow range at the beginning of the year?
Yeah, I think first of all, with the new way of structuring our outlook is to align it with how we talk. Our focus is on improving the underwriting profit, grow the underwriting profit. That's what makes our investors richer. In terms of our ability to pay the dividend and doing the share buyback. And of course, that growth in underwriting profit also comes from growth in business, which is why these two items is the key sort of communication of the profitability and success of Sampo going forward. So that's why we moved away from the previous way of guiding, although it absolutely doesn't mean that we think less of our combined ratio target of below 85%, because of course margin discipline is a key part of generating that profit growth going forward. In terms of the narrow range, it's not, I would say, materially different than how we have communicated a combined ratio range before. If you sort of just took that combined ratio and multiplied it by our insurance revenue. So from that perspective, that range is fairly similar. And then also I would say in terms of style of guiding, we sort of start the year with a somewhat conservative view of the business. That's why you have the range with sort of a lower end and a upper end, where we of course will do our best to achieve the best part of that range, so to speak.
Would you describe the range as a conservative guidance, or is it aggressive, or something in between?
I wouldn't call it aggressive. We don't. There's nothing in our guidance where we sort of base ourselves on luck, and of course that is a statement where you can argue that non-life insurance always include a bit of luck. But we have plans and actions and activities for all the planning that we do. Then in terms of conservative, I guess in the beginning of the year, it is natural to be a little bit more conservative in the non-life insurance industry, since you have 11 months left than maybe what we would like to be later during 2025.
Exactly. Then lastly, I have to apologize beforehand, but the last question will be about the dividend, which is, as you implied already, that it's a result of good operational results. Should we think that the present rate of dividend or dividend level, it's sort of sacred, and all the excess capital you generate in the actual business will be perhaps returned to shareholders via buybacks, and we should see a slow growth of dividend rate over time, but the excess capital will be deployed with share buybacks? Is this thinking correct?
I think the regular dividend will be the core part of our capital distribution, where with the 170, where we will be spending more than 900 million on the regular dividend. And there's no plans to sort of not make the regular dividend a core part of our capital distribution. Then of course, to compare it to the last 2 years, where during the restructuring, where we had sort of all kind of effects from selling Nordea shares and Mandatum and the like, and paid extra dividends because of these one-offs, if you like, is of course not a part of our balance sheet management going forward. But regular dividend will be a core part of the capital distribution. And there's no plans to sort of cut the dividend or anything like that in terms of the levels you were alluding to. Then what is also the situation is that we have many shareholders who also prefers actually a share buyback in terms of capital distribution. And when doing, like we've said for a while, when doing a combination of both dividends and share buybacks, we have a possibility to satisfy many of our shareholders, which is, of course, is a key part of our capital distribution strategy in the first place. So to think about, like you said, a share buyback as also a regular part of our capital distribution would be natural going forward, without at all saying that we think differently on the regular dividend, the predictability and stability of our regular dividend.
So are the buybacks there? You intend that buybacks are also systematic, but perhaps still more flexible depending on your capital requirements, or if you find perhaps some interesting M&A targets abroad.
In terms of the size of the share buyback, that could of course vary. I'm sure then if you have a stable development in the profitability, I guess there's an element of stability in the share buyback as well. But we would review that on a sort of, like we said, at the CMD, a 12 to 18 months basis, probably maybe more than 12 than 18. In terms of the flexibility we have, it's not really a part of our thinking because M&A isn't our core focus for capital deployment during this strategic period. We just want to create clear and understandable and predictable capital returns, which is a combination of a regular dividend and a share buyback.
Thanks for interesting discussion, and thank you for having me here.
Thank you. Good to see you.